Hi, welcome to our presentation on the Audit Inspection Report from July 2021 to June 2022. As of October 2022, a total 743 findings have been reported, signifying the critical importance of our discussion today. My name is Amy, and along with my group member Samantha, will be presenting. Introduction. This report is crucial for providing light on the most important aspect of audit practice. It's been highlighting the significance of understanding audit evidence and its functions in ensuring the veracity of audit practice. In this presentation, we will drift into the concept of audit evidence, analyze the case study, material to gain insight into its practical implications, and investigate the broader impact of these findings on the credibility of audit practice. On the basis of these essential findings, we will provide audit information users with valuable advice. First of all, we need to know what is audit evidence and why is it important. The audit evidence is the information and paperwork that auditors gather when they look at the financial statements and relate records of an organization. It is the basis on which auditors decide if the financial statements are correct, full, and fair. Audit evidence can come in many forms, including financial records, reports, invoices, contracts, bank statements, and correspondence, and so on. Why is audit evidence important? Audit evidence is essential because it forms the foundation of trust in financial reporting. It provides assurance that financial statements are accurate and free from materialities misstatement. This evidence helps auditors assess risks, detect irregularities, and ensure legal compliance, ensuring the credibility and integrity of financial information for stakeholders.
What does the case study material tell us about audit evidence? So the case study explains that a negative finding meant auditors did not obtain reasonable assurance that the financial reports were free of material misstatements, which means that auditors did not have sufficient evidence to support their opinions on the financial report. There were 14 audit firms inspected in 18 different industry groups. Of the 45 audit files reviewed, 60% of them had negative findings. And of the 146 key audit areas reviewed, 36 of them had negative findings. Compared to last year, this is an increase of 4%. Of the 6 largest firms that were also reviewed, 32% of them had negative findings, which is an increase of 9% from last year. The largest number of negative findings were in the following audit areas: revenue and receivables, asset values, and impairment of non-financial assets. The 75% of negative revenue and receivable findings were in first, test of details. So with inadequate sample sizes and techniques, source data used was not tested for completeness or accuracy. There was insufficient independent evidence for items selected. The second being internal controls work, which was an inappropriate reliance on internal controls. The third being risk assessment procedures, so no procedure performed or not performed appropriately. There was not testing and or challenging the relevance and reliability of data and assumptions, and there was inappropriate accounting policies for revenue recognition. So 75% of negative asset values and impairments of non-financial assets were in first, forecast cash flows. So cash flows including capital expenditure, growth rates, and or terminal value were not reasonably or adequately tested. They were not challenging forecasts where the entity had not met forecasts historically. And the second is other key assumptions. So discount rates, exchange rates, commodity price, or other key assumptions were not appropriate or reasonable. and the last being expense capitalization. So there was inadequate understanding of the nature and complexity of projects, and there was inappropriate accounting policy for recognition of non-financial assets. The case study also reviewed 220 financial reports, which led to material changes of 4% to net assets and profits of financial reports, and a significant enhancement of 2% to operation and financial review business disclosures. So 9% of audited entities made material changes to their net assets, profits, or financial information that had already previously been provided to the market. The identified negative findings from the audit file were both for before and after the material changes and were related to concerns that were already being raised by ASIC. The case study tells us that all negative findings are important and should be addressed by the firms because the auditors had not performed or evidenced all the work necessary to support their opinion on the financial report. This is the impact of the case study with respect to the veracity of audit practice. So the Auditing Assurance Board states the objective of an auditor in conducting an audit of the financial report is to obtain reasonable assurance about whether the financial report is free from material misstatements. And this will be whether due to fraud or error, and this will enable the auditor to express an opinion on whether the financial report is prepared in all material respects in accordance with the applicable financial reporting framework. The second is to report on the financial report, and this means to communicate as required by the Australian auditing standards in accordance with the audited findings. So the case study showed us that 60% of audit files reviewed, the auditor did not have sufficient evidence to gain reasonable assurance that the financial report were free of material misstatements, meaning over half of the audit reports reviewed could have been a financial report with a material misstatement. So, ASIC also states the key to inform markets and investors is the quality of the financial reports, and the purpose of an independent audit is to provide confidence in the quality of financial reports. The case study shows us that 9% of audited entities made material changes to their net assets, profits, or financial information after being provided to the market. This diminishes the public's confidence in the independent assurance auditors provide. If any of these companies had failed, but their financial reports did not indicate their diminishing financial position and/or issues of going concern, there'd be questions regarding the role the auditor played. Same would happen if investment decisions were made using these financial statements that did not reflect the financial position/performance of the company. So the case study tells us that auditors are not conducting quality audits, the validity of the audit evidence obtained, and the accounting estimates and treatments are not being critically assessed, and auditors are not exercising professional skepticism. This all diminishes the confidence in the audit practice and the independent assurance auditors provide. So,
Alright, here is the advice to audit information user. Firstly, understanding findings. Carefully examine the entire report to gain a comprehensive understanding of the issue identified during the audit inspections. Assess significant. Categorize findings based on their potential impact. Assess whether there are minor issues or more significant problems that could affect the accuracy of financial statements. Also, prioritize your attentions on findings that have the potential to materially affect the financial health and reporting accuracy of audit entities. Context matters. Understanding the context in which the findings occurred, were they specific to certain industry, type of the audit engagement, or a particular audit firm. Engage and seek clarity. Reach out to the audit entities to discuss the findings, seek explanations and assurance about their plans to address the identified issues, and ensure that the audit entities are transparent about the actions they are taking to rectify the problems identified in the report. And seek expert guidance. If you have doubt or concerns about findings, consider seeking guidance from professionals who specialize in finance or legal matters. These experts can offer opinions and analysis to help you better understand the implications of the findings and potential risks to your investments. Adapt strategies and monitor progress. Depends on the severity of findings and their potential impact on audit entities. Be prepared to adjust your investment portfolio or risk management strategies accordingly, and stay engaged with the situation by keeping an eye subsequent reports or updates related to the findings, and ensure that audited entities and audit firms are transparent in reporting their progress in addressing the issues identified in the audit inspection report.
Conclusion. Audit evidence is the information that supports and corroborates auditors' assertions on the financial statements and or internal controls over financial reporting. So the case study shows us that 60% of audit files and 36% of audit areas did not have reasonable assurance that the financial reports were free of material misstatements, meaning auditors had not performed or evidenced all work necessary to support their opinion on the financial report. The case study also tells us that auditors are not conducting quality audits, and the validity of audit evidence obtained and the accounting estimates and treatments are not being critically assessed or exercising professional skepticism, which is diminishing the confidence in the audit practice and the independent assurance auditors provide. Based on these findings, users of the audit information should aim to understand findings, assess their significance, consider the context, seek clarity and guidance, and adjust strategies and monitor progress of the audit information. Thank you.